Something is quietly changing in America right now. You can see it in shopping malls, you can see it in strip centers, you can see it in empty storefronts with liquidation signs hanging in the windows. Retailers are closing their stores across the country at a pace that is starting to alarm economists, investors, and commercial real estate owners all at the same time. And for many Americans, the question is becoming impossible to actually ignore. And that question is, why are so many of stores suddenly disappearing? It's interesting because we're going to talk about this brand in and of itself and its decline. You see, according to multiple retail reports, thousands of U.S. stores are expected to close in 2026 alone as companies are battling rising costs, changing shopping habits, and slowing consumer demand. At first glance, some executives describe these closures as strategic repositioning, but that's just to keep their shareholders at bay and keep them from selling and liquidating their stock. But you see, underneath the corporate language, something deeper may be happening. Economic activity appears to be slowing rapidly, and this will affect real estate markets around the country, including residential. Consumers are becoming more cautious. Discretionary spending is weakening, and many businesses are realizing that they expanded too aggressively during easy money years when interest rates were low. Well, let's take Champ Sports as an example. At its peak, the chain operated more than 500 stores across America, but over time, that number has fallen dramatically as parent companies closed underperforming location and restructured operations. Even before Dick's Sporting Goods acquired Foot Locker in 2025, Champs had already been shrinking for years. Since the acquisition, closures accelerated further, with roughly 200 locations disappearing from retail landscape. And Champs is far from alone. Retail chains across industries are downsizing. Department stores, shoe retailers, electronics stores, restaurants, especially specialty apparel brands, and even once dominant mall anchor stores. Some of this is absolutely tied to changing consumer behavior. And it's important to realize that because as you see this changing behavior, you start to invest differently, especially in real estate. Americans increasingly are shopping online. They compare prices instantly. They expect fast shipping and direct delivery. Major brands like Nike and Adidas shifted heavily towards direct-to-consumer sales, reducing their reliance on third-party retailers like Foot Locker, Champs, and even Dick's. In simple terms, the brands realized that they could make more money selling directly to customers, instead of sharing profits with middleman retailers. That change fundamentally weakened many brick-and-mortar chains. But there's another factor that may be even more important right now, and a way that we could probably take advantage of that. You see, the economy itself is slowing pretty rapidly. Over the last several years, Americans absorbed wave after wave of financial pressure. Now that's changed. You see, higher rent, higher food prices, higher insurance, higher interest rates, higher car payments. These are all pressures put on the American consumer so they have less money to shop at retail stores. Eventually, something has to give. And often, the first thing consumers cut back on is their discretionary spending, especially sporting goods. New shoes can wait. A second pair of sneakers can wait. Eating out can wait. Impulse shopping can wait. Hey, that extra set of skis that you're going to buy for next winter, they can wait. Retailers feel that slowdown very, very quickly. Foot traffic drops off almost overnight. Inventory starts to pile up and their margins shrink. Debt becomes harder to service. So they start closing these places down because suddenly stores that once looked profitable begin losing money. And this is especially dangerous for chains operating hundreds of physical locations with massive lease obligations. Many retailers cannot simply walk away from stores overnight. Lease contracts can remain active for years, forcing companies to carefully time closures around lease expirations or negotiate costly buyouts. That is why some retail collapses happen slowly instead of all at once, because they have to consider the cost of closing some of these stores down. One store closes here, one store closes there, and suddenly the entire regions begin shrinking. And when enough stores close, the economic ripple effect spreads far beyond retail itself. Think of all the employees in a store that closes. They no longer have a job. They have to go find something else. It gets crazier and crazier. And then commercial real estate owners, they lose tenants. Excuse me. The shopping centers, they lose foot traffic. Restaurants lose nearby customers. Cities lose tax revenue. Warehouse demand slows. Trucking slows. Advertising slows. It is a huge cycle. Even employment can weaken because, like I said, these retailers, as they close down the stores, there's no need for them anymore. So the employees have to go find other work. This is a dangerous feedback loop. And this is why it's important to prepare now. As you see this, you know that the price of commercial real estate is going to collapse even further than it already has. And that's going to ripple into residential real estate because everybody that's losing their jobs, whether it be Facebook, Meta, Amazon, Dick's Sporting Goods, Starbucks, or any of these companies that are announcing 5%, 10%, 12% of their workforce being laid off, they're not going to be paying their mortgages soon, or they're going to hit the market soon while they have a little bit of equity left to be able to run onto the open market and take advantage of their equity and try and cut bait now and try and restart somewhere else. This is why we have to watch this. I hope you got something out of this. There's a lot of sporting goods stores closing. When a company like Dick's goes out and buys Foot Locker and all Champs and all these other stores, you know the first thing they're going to cut are those brands instead of their parent company. All right, with that being said, the Real Estate Ninja is out.